Hello, good morning to all the students of BFW2751. How are you all today? I really hope you all are doing fine and being always inspired to catch up with the new learnings of this unit day by day and week by week. We are exploring new areas in the derivatives. I think it's very interesting for you. And today, specifically, we are exploring into the properties of stock options. See, options can be written on almost any underlying assets. But the variations in the price movements and all these things, stocks are the easiest to use as a sample. So today we are going to focus only on shares, stock options. What are the factors which will be affecting the stock option pricing? When I say options pricing itself, the meaning is the premium. The premium what you're going to pay for a long position or a premium what you're going to receive in the short position. Okay. In your textbook, this refers to chapter 11. If you have already purchased the textbook, it is with you. Do a thorough reading on this, but of course, we are not going to cover all the part of the chapter. We will be learning until put call parity only, which is sufficient for you at this moment, where you're going to see other things more detailedly in the next few weeks. Let us get into the lecture itself. Today's lecture outline is that firstly, we're going to explore what is the difference between American and European stock options. American stock options has got their own features or properties, and European stock options have got their own properties. We will see after this. The second part of it, we're going to analyze factors that affect the option pricing or factors that affect the option premium, whether the option premium gets higher or lower. What are the factors which is making the premium to become expensive or to become cheaper? The third thing what we're going to see is the usual thing is the assumptions in the option pricing. It has been there, a set of assumptions are there always. You have seen this even in the forward and futures. And now we're going to use it here. Let us assume there are about 4 assumptions we will explore for this. But we are exploring into something new here is that the upper and lower bounds of the option pricing, in the option pricing. What are the upper level, what the premium can go to, what is the limit for the upper, and what is the lower limit for the lower side of the option premiums. So, and finally, the most important thing in this lecture is that to understand what do you mean by put call parity relationship in option pricing, where you can identify the put pricing by not having the put detail, or you can find the call pricing by not calculating the call in the normal way. This will become a shortcut, but you must know the put call parity relationship equation very well. Okay, are you all comfortable so far? Okay, we'll move on. Okay, American versus European stock options. What are the differences? A European call option is an agreement between two parties giving the holder the right to buy a certain asset, that is one stock, for example, in this unit, for a price of K, that is a strike price, at the time, maturity time. It gives you a right. As a buyer, it gives you the right to buy at a prefix price K at a future time T. Of course, the specification of the asset is, in this case, one stock. You are writing an option on a stock. You are not buying the stock itself. You are writing an option on the stock, right? So why do you write an option on the stock is mainly because you want to prefix the price. If you are going for a call option, European call option, you are worried the price of the stock will be going up. So you set the ceiling price K now to be exercised at the time T. So European call options can be only exercised at the maturity. That's the main property of European call option. Now, the second thing is European put option. It's an agreement between the two parties giving the holder the right to sell certain asset, to sell one unit of stock for a prefix price now, K, that is a strike price, at a maturity time T. Now, why do you go for a put option is mainly because you are worried that the prices of the stock will be falling and you have it now. And you want to sell it at a certain price which you fixed, which could be a little what is comfortable to you, and you let the writer to write the put option or European put option on that strike price or prefix price, where you can sell it at a later time when you are in the outlook that the price of this particular stock might be going down very much. Right? So again, this is a European put option. Therefore, you can only exercise it at the maturity. Well, we're going to what do you mean by American options now? Whether it's an American or put or call option or put option, it's an agreement where one can use the above rights anytime between the time zero, that is the inception time now, and between time t, whenever you feel that the for a call the ST is higher than K, gives you sufficient amount of money, you can exercise it at K immediately. But of course, you're exercising at K with the idea of buying it at K and selling it at ST, which is much higher, where you can get the immediate profit. But if you're going for a put, American put, that means it gives you a chance to sell off or exercise your put option at K anytime between now and time T. Or the maximum is that you have to exercise it at time T, which basically means that you can do early exercise. American options allow you to do early exercise. That's the big advantage here. Anyway, to be sure of that you are not very confused, the word American or European does not refer to any geographic region. That is an American option is written in America or European option written in Europe. No, these are the two styles we have. You want to go for a European option. In fact, most of the options which we are going to talk about is European option, where you can exercise it only at the maturity time. American options, on the other hand, gives you a chance to do early exercise if you want to. Most exchange traded stock options have a life less than 1 year. That's how the options move, right? We are talking about stock options here, right? Well, we'll continue. The next thing we have to learn before we continue in this lecture is that we have to understand the notations in option pricing. You see all these symbols where these are the acronyms or one word symbol, which you're going to see throughout this lecture in many equations, where you must specifically identify what that notation refers to. Okay, the small c is the European call option price or the premium of the European call, the small c. The capital C is the American call option price or the premium of an American call option, that's capital C. Likewise, small p is the European put option price or European put options premium. The capital P is the American put options premium. I think it's quite clear to you. S0, as usual, is the stock price today at the inception. What is the stock price today? And ST, which is a very sensitive thing here in the options, is the stock price at the maturity, stock price at the options maturity. The underlying is the stock here, so the stock price at maturity, how does it end? And whether the ST is above K, the strike price, or below K, the strike price, depending on whether you're going for a call or you're going for a put. Well, T is the lifetime of the option, or we call it as time to expiration of the option. Small sigma is the volatility of the stock price itself, is the standard deviation function, how risky or what is the variations in the underlying stock price for the past 6 months or 1 year. So we see how large is the jump either side. D is the present value of the dividend. Sometimes we do take into account of dividends. Of course, we are talking about stocks. So stocks have got the right to earn dividend. What happens if we bring in the dividend component? But largely, most of the time, we'll speak on the stocks which don't earn any dividend. Non-dividend paying stocks is easier. But of course, finally, we'll come to a situation where what happens if that stock is paying dividend? Then we have to account for the present value of the dividends paid during the lifetime of the option, because dividends won't be paid immediately as you are getting into the option. Maybe there's a certain time, maybe after 1 month or 2 months or 3 months, the dividends will be paid, but it should be considered only if the dividend involves within the lifetime of the option. Let's say you're going for a 3 month option, if the dividend is paid within the 3 months, then it is taken into account. Of course, the small r, as usual, is the risk-free rate for the maturity with compounding, continuously compounding. So here we're going to calculate based on continuous compounding for the risk-free rates. Lending rate and borrowing rate will be same. That is the risk-free rate. Okay. Well, now you understand the notations you have taken into account, and you must remember this: which symbol belongs to what. Okay. Now moving on, we have got 6 variables here. These are the ones which will be the effect of the variables on option pricing. Whether the two first column here, from the column 2 and column 3, are the call and put of European put options. You can see small c, small p. And the last two columns are the American call and put. Right? So we have got about 6 variables here. The first variable is current stock price S0. Second is the strike price. Third is the time to expiration T. Fourth is the volatility sigma or the standard deviation. Fifth is the risk-free rate R. D finally is the future dividends. We're going to take into account of all these as increments. What happens when there is an increase in these variables? What will be the effect on the call price or the put price of a European option? So looking at the first one, if the stock price increase, what happens to the call? You know very well the payoff for a call is ST minus K, right? The difference is ST should be more than K. If there's a stock price, if the stock price increase, then it should be giving you a higher return. So the call should be worth more. So based on that, the premium will be higher because the seller of this call will be having the risk of being exercised. When it's exercised, he has to pay you. So therefore, the call premium will have a positive value here, because if there is a view that the stock price is increasing, then the call premiums will be higher. Well, when the stock price is increasing for put, it is good. People won't exercise because it is the K minus ST. If the stock price is increasing, there are high chances that the put won't be exercised. So if the stock price is increasing, then the put value will be lower. Well, now the other thing which is in the combination of between K and ST is the K, that is the strike price for a call. If the strike price is increasing, you must know it is between ST minus K, K becoming a minusing factor here. If K becomes incremental, the call value will become lower. So likewise, if the K is increasing, it will give you a negative effect on the call price. While if the K is increasing, for a put, it is K minus ST. K is the bigger figure there. If K is getting bigger, holding ST constant, because the difference becomes higher and higher. So the put price or put premium will be larger, will be having a positive effect. Okay. Similarly, the same thing happens to the American call options and put options. This between current stock price and the K gives the similar effects to American call and American put also. You can see the symbols are same. But while time to expiration, time to expiration for a European call, it depends on how it reacts. That's why I put a question mark there, indicates that the relationship is uncertain because it depends on whether you are in a call and you have got how long to maturity. Because European call options only can be exercised at maturity. So if you have a larger time, longer time, let's say you got still another 2 months, there's a chance, there's an insurance at least, the price may go up by then. At the same time, there are also negative chances that it may go down. So it is quite uncertain. The, the nearer you get to the expiration, you are quite certain that in which direction the price may jump. But when there is a long time, when the time to expiration is quite long, of course, what we call it as time value in the option valuation, time value is longer. You have got longer time to see the price moving either to positive or negative. Similar, same thing to put options in European option, same effect because the longer the time it is, longer the uncertainty also. But for American options, it both gives you positive signals here because there is no such thing as time to expiration here because you can immediately exercise. You can do early exercise. So the only thing here is that if the time to expire is long, and let's say for a call, the ST is higher than K today, but if you have another 2 months, do you want to exercise it today at K to immediately sell it at ST? Or are you going to just keep it thinking that the ST might be still going up and up and up until the maturity? So if the time to expiration is larger in the incremental side, for American call, it gives you a positive sign that you can hold it on where it might be moving higher for your call. At the same time, for a put, it might be going down. You have more time as an insurance here. You can hold it on to see that the time value will give you a variation which you are deciding to. Well, we see the volatility, the sigma, that is a standard deviation. For a call, for a put, both side European options, higher the volatility, larger the call premium because higher uncertainties. Uncertainty about how the stock price will move within the next time limit of the time to expire gives you certain uncertainty. If the smaller the standard deviation, lower the risk here of the uncertainty. But if the standard deviation is increasing, the volatility is increasing, then it will give you an incremental value in the call and also will give you an incremental value in the put. Both the side, the call premium and put premium may be higher according to the volatility levels. Similar to American options also, that is no exception here. Okay, risk-free interest rate. Well, risk-free interest rate has got a positive effect for your call premium. Higher the risk-free interest rate, if the risk-free interest rate is higher, then you will see that your borrowing cost becomes higher and higher here. While for a put, you can see that it's a negative effect. The similar thing for American call and put. Future dividend. See, if for a European option, during the lifetime of the option, if a dividend is declared, you will know the value of the stock will fall at the post dividend time. Let's say a dividend is paid somewhere in the second month of a 3 month option. So the stock value will fall. If the stock value falls, then the option premium will have a negative effect. Normally, future dividends. That's why if there is a dividend going to be declared, then you will see for a call, the payout. I mean, your exercising option is lower. For a put, yes, you are waiting for the price to fall. If if the if the dividend is declared, then the prices may fall further. Then for a put, if the price falls further, there's a higher chance of exercising and you have to pay out larger. So it's a positive effect there. So you can see how these things affect, and we will see in the next few slides how these things affect. Now going on further, let us see precisely the factors affecting stock price options prices. How what we saw the six factors. Now we'll see why and how they affect the stock option prices or the determination of the premium. Okay, firstly, we'll see this combination of the two. Stock price has T and the strike price K. For call options on stocks, the payout depends on how much the stock price is ST exceeds the strike price. I told you it is ST minus K. The larger it gets, larger the payout will be. So call options become more valuable as the stock price increases and less valuable as the stock price decreases. Mainly you should see the long call option function maximum is ST minus K, right? So if the ST is increasing, this become larger and K being constant, you will see the difference become higher and higher. So the call price will be determined by what are the chances that the stock prices will be going up. And for uh, short short put option, it is a minus side of it of ST minus K plus the C. I think this is supposed to be short call option. This is supposed to be a short call option. For a short call option is the opposite of this. It is the minimum of ST minus K plus the call price you have earned as a seller. Well, for a put option on the stocks, the payoff on the exercise depends on by how much the strike price exceeds the K. Here we are talking about the K being the subject matter here. The higher the K, the larger the payout will be. For a long put option, is K minus ST. When it's K minus ST minus P for the profit function, if the K is getting larger or the K gets higher, the payoff will be higher. For a short put option, is minus max of K minus ST. So if the K gets higher and higher, of course, you're going to have a higher chance of payout, but of course, you're going to earn the premium. Okay, times to expiration. Both American put and call options become more valuable, or at least do not decrease in value as the time to expiration increases, the T. Okay, because why? As the time to expiration increases, you have got more insurance value, thinking that the price may move more favorable to your exercising. When you want to do early exercise for a call, if you exercise it today, you have to exercise it at K. And what about the ST at that moment? If the ST is above K, then you want to exercise it. But definitely, if you have more time to go, you will be willing to wait for the ST to go further up. If at all it falls, you can buy it in the market lower than the K. But if the ST is above K, what are you going to do by exercising the K today? You have to pay that amount of money and buy the stock immediately. And are you going to immediately sell it? But if you're going to immediately sell it also, you will be waiting. It is a human greed who will wait for it to go up further if it is in the bullish direction. So for a European put or call usually become more valuable as the time to expiration increases because you can't do anything in between. So you wait for the expiration time. If the longer the expiration time, you have got better chances that your ST or the final price may move towards your advantage. Volatility again we saw just now. The volatility of the stock price is to measure how uncertain are the future price movements. As the volatility increases, the chances that the stock will do very well or very poorly increases also because this is a strike of both sides. So the uncertainty, as the uncertainty increase, of course, the chances of something to be paid off also increases. For a call, maybe the price will go up too much and it will be exercised. Or for a put, if the prices falls too much, also will be exercised. So therefore, it gives a positive effect on the premiums. Okay, risk-free interest rate, as we see it. When the risk-free interest rate increases, required rate of the investors will increase. The present value of the future returns of the option holders will fall. Therefore, the combined effect of risk-free interest rate increase will decrease the value of the call option and increase the value of the put option. This is how the effect will be on the call option and the put option because this clearly says that the risk-free interest rate increase or the interest rate increases, the required rate for the investors will increase, right? So, and the present value of the future returns of the option holders will fall because you're discounting it. So, therefore, the combined effect will be interest rate increase will decrease the value of the call option and increase the value of the put option. So, finally, we are going to look at the expected future dividend. As I told you earlier, dividends can reduce the stock price at X dividend date. This can reduce the value of the call option and increase the value of the put option because if the stock price movement, the first one you saw, if the ST is higher, it will increase the value of the call option. If the ST is getting lower, that will increase the value of the put option. Okay, right. Well, as I told you, we'll explore the assumptions in determining the option prices. As usual, we have to assume these few things. We assume that there are some market participants for which there are no transaction costs involved or commissions or like that. Number two is all trading profits, the net trading losses or profits are subject to the same tax rate. Hmm? It's not that when you profit, you have got a different rate, and when you lose, there's nothing. Profit or loss is subject to same tax rate. And very important is that borrowing and lending interest rate is at the risk-free interest rate is possible, the same interest rate for lending and borrowing, and it is continuously compounded. And more important is that market does not permit arbitrage opportunities to persist. Market allow the arbitrage opportunity to exist, to raise, but it does not last too long. Why? Because huge number of people are participating here and the information about the mispricing travels fast and the arbitrage opportunity dissipates very fast. These are the assumptions which we're going to rely on to continue the upper bound, lower bound, and also the put call parity. Okay, now we look into the upper and lower bounds of the option pricing. Upper bounds on calls and puts. Let us see the call options first. For a call option, no matter what happens, the option can never be worth more than the stock price. The option price or the premium can never be higher than the stock price at the initial inception itself. If the stock price is $40 today, can I charge you a premium of more than $40? Hmm? Then why do you want to buy the option? You can buy the stock itself. Hence, the stock price is an upper bound of the call options or the call option price or the premium, where we see for European option, the call should be lower than S0 or as at least as equal to S0. And for American options, the same thing. The premium of a call option can never be more than the stock price. That is the upper bound for a stock price or a call option. You remember this carefully. When I say calculate the upper bound of a call option, the upper bound of a call option is nothing more than the stock price itself at the inception. Okay, what about the upper bound for a European put option? Just now we saw is a European call option. For now, we look into European put option. For European options, at the maturity, the put option cannot be worth more than K. At the maturity, the put option cannot be worth more than the strike price itself. Therefore, its current worth cannot be more than the present value of the strike price itself. Therefore, we say the put premium should be either should be less than the present value of the strike price. The premium of the European put option cannot be more than the present value of the strike price. Why we are calculating the present value? Because for European option, there's a you can't immediately exercise it. You have to wait for exercising it at the maturity time. So there's a time value between now and the strike price exercising because there's no early exercise in the European put option. So therefore, you have to present value it. That's not the case for American put options because American put options can be exercised immediately, so you don't have to present value the K. So that is why for American put option, the put option can never be worth more than K. So the large P, the American put options price or the premium, should be lower than K, strike price. For call, it should be the upper boundary is the stock price. For put, the upper boundary is the strike price. But for European put option, as the strike price will be expiring at the expiry of the maturity of the option, we present value it now. So the premium should not be at the current moment, should not be more than the present value of the strike price. While American option gives you the option to or advantage to exercise immediately, so the premium should be lesser or equal to strike price itself. If an option price is above the upper bound or below the lower bound, which you're going to learn afterward, then there are profitable opportunities for arbitrages. It will create more opportunities for arbitrage. Exploitation of arbitrage will come in, but of course fast. Although we did an assumption just now, does not allow arbitrage opportunities, but arbitrage opportunities do exist from time to time, but the assumption is that does not persist too long. Okay, we look at an example for this upper bound. We'll give you a clear idea now. Okay, let's see this example. What is the upper bound for the price of a 6-month European call option? A 6-month European call option on a non-dividend paying stock when the stock price is 80 and the strike price is 75, the K. So S0 is 80, K is 75, and the risk-free interest rate is 10% per annum. So it is pretty simple here when you're talking about the upper bound of a call option and European call option. Is straight away that the call premium should be as much as the stock price itself. That is, should be $80 is the upper bound. That's the maximum it can go. Either it's an American call or European call, upper bound is just the stock price itself. Clearly understood, right? Okay, what is the upper bound for the price of a 6-month European put option then? On a non-dividend paying stock, when the stock price is $80 and the strike price is 75, and the risk-free interest rate is 10% per annum. Well, we are talking about a 6 month European put option, and I told you for a put option, the K, the strike price becomes the primary thing here, and because it's a European put option, then you have to present value the K according to the time. So $75 e to the power of 0.1 times 0.5 gives you a value of $71.34 is the upper bound of the European put option. For an American put option, it's very easy. Just the K itself is $75. Any other value other than either higher than or lower than this upper boundary will induce to arbitrage possibilities. Can you see that? Okay, lower bounds now. We just saw the upper bound for a call and upper bound for a put, either for American option or European option. Now we look into the lower boundaries of the European call option. The lower bound, it is said that the premium of the European call option cannot be lower than the difference between the stock price and the present value of the strike itself. So lower bound for a European call, what is the lowest the premium can go is it should not be lower than the difference between the current stock price and the present value of the strike. If it gives you zero, then it's no use. So the lower bound for the price of a European call option on non-dividend paying stock is S0 minus K e to the power of RT minus RT because you're discounting it to the present value. We give you an example. Let's say S0, current stock price is $20 and the strike price is $18. Risk-free interest rate is 10% per annum. The time to expire is 1 year. So what is the lower bound here? So we can calculate that it is $20 minus present value of the strike at 10% for 1 year. So you get it as $3.71. That is the lower bound. So the premium for this call option cannot be lower than 3.71. Assuming that the European call price is $3, which is much lesser than the theoretical minimum of 3.71, what will happen? An arbitrager can short the stock and buy a call, which will provide a cash flow. You see, you short the stock, you sell the stock for $20, and you buy the European call option at the price of $3, immediately you get $17. If you invest the $17 at 10% per annum for 1 year, it will grow to become $18.79. As the stock price is more than $18, the arbitrager can close out the position, short position, and make a profit of 18.79 minus $18. Okay, strike is 18, right? So you'll get about 79 cents. If the stock price at expiry becomes lesser than $18, that is the ST becomes lower than K, let's say $16, then the arbitrager makes more money. That is 18.79 minus 16 because you're closing up by buying the short position. So you're buying it at an even lower price. So you make 2.79. This is how the arbitrages work. But if the premium does not go below the lower bound, then there's no arbitrage possibility. So you saw the upper bound for a call and lower bound for a call. Now, lower bound for put. Lower bound for a price, lower bound for the premium of a European put option on a non-dividend paying stock should be more than present value of the strike minus S0 because for put option it is K minus ST, right? So therefore, it is the present value of the strike because it's a European put option. That's why you present value of the strike minus the S0. For example, suppose S0 is 37, K is 40, risk-free return is 5% per annum, and the time is half a year, that's 6 months. So what is the lower bound of this European put? So it becomes present value of the strike minus S0. 40, you have present value it, and then minus the 37. So you get about $2.01. That should be the minimum theoretical lower bound price for this put option, for European put option. Assuming that the European put option price become $1, oh my God, which is less than the minimum theoretical price of $2.01. An arbitrager can borrow $38. Why? Because $37 is the price of the share plus $1 for the premium for 6 months to long a put and the stock. He buys the stock as well as he buys the put. At the end of 6 months, the arbitrager will require to pay back the $38 by compounding it to the interest rate, which becomes $38.96. If the stock price is below 40, the arbitrager exercises the put options for $40 and pays the loan, thus making a profit of what? He exercises it for 40, the K, and minus the repayment of the loan at 38.96, and he makes about $1.04. If the stock price is greater than 40, then even more enjoyable for him. The arbitrager discards the option and sells the stock, let's say at $42, and he makes more profit. Now, 42 minus 38.96, he makes $3.04. Does that make sense to you? Okay. Now, we have the most important part of this lecture. There's a put call parity relationship. Of course, you will understand this better in the next few weeks, but it's good to start now. There is an important relationship between the prices of the European put and call options that have the same strike and the same maturity. The condition is it must be the same strike, same maturity. Well, European put options, because not much has been discussed about American options on the put call parity, but of course it's a little complex. We don't discuss it here. It's out of your scope. For now, we just concentrate on the European put call options, which has got the same strike and same maturity. How do we balance out for put call parity? Where if I give you the put price and the current price of the stock and the strike price, give you the present value of it, how to calculate the risk-free interest rate and everything, then you can calculate the call price. So the basic equation here is you have a put on the stock and you buy the stock as well. You've got a put premium plus S0 should equals to call premium plus the present value of the strike. Easy as that. Because this is the prime equation. The first equation here is the prime equation. That is P plus S0 equals to C plus K e to the power of negative RT. Or it could be the other way around also. C plus K e to the power of negative RT can be equal to P plus S0, whichever way. But we can play about with this equation in so many ways that what about P alone? If you want to just see what is the value of P, you just bring the S0 to this side. That is C plus KERT minus S0. If you want to calculate the difference between the call and call minus P equals to S0 minus KERT. There's a call comes this side and the P goes to there and the S0 here. So call itself equals to what? So as I told you, call equals to P plus S0 minus KERT. So however you combine, you can calculate one for another. It should be equal if the parity holds. If the parity doesn't hold, then it gives you a chance for arbitrage. This relationship is known as put-call parity. It shows that the value of a European call with a certain exercise price and the maturity date can be deduced from the value of a European put with the same exercise price and the exercise date, and vice versa. But the condition must be that they must have the same maturity and same strike price. If I give you the value of the put option, then you can calculate the value of the call option without going into calculating it in any other model like Black-Scholes model or even to go into binomial models. So it can be a straight shortcut here. For example, suppose that the stock price is $31 and the exercise price is $30. The risk-free interest rate is 10% per annum. The price of a 3-month call option is $3. So the small c is $3. What should be the price of a 3-month put option if the put call parity holds? The condition is if the put call parity holds. So now you are calculating what is the price of the 3-month put option. You're going to calculate the small p. So you have got the S0 now as 31, and you have got the strike price. Okay. Now C plus K E to the power of minus RT equals to $3 plus 30, present value of it should be 32.26. You already calculated this part of it. C plus KERT. So you got it as 32.6, 32.26. So balance it out to the other side. P plus S0 should be equals to P plus 31 equals to 32.26. That is the case, then what is the P itself? Bring the 31 down here to minus from 32.26, you get it as 1.26. We can easily calculate this. But if this is violated, if this relationship is violated, then a lot of arbitrage opportunities exist. You can explore that in the tutorial questions which I'll give you. So therefore, I will end the lecture session here because we have got many other things to do in the future weeks which will enhance the knowledge of these properties of stock option. So end of lecture week 6 now. Next week we're going to study the trading strategies involving options. Read chapter 12. Okay, until then, take care. Good. You all do good, and we'll meet you in the tutorials and consult.